A short video about football player amortization and how it works. So what is player amortization and how does it work? Amortization in football, also known as transfer amortization or player amortization, refers to the accounting practice of spreading the cost of a player transfer fee over the length of the player's contract. This allows clubs to spread the cost of a transfer fee over a number of years, rather than taking the full hit in one year. Player sales can also help clubs with financial fair play. When a club sells a player, the transfer fee received can be used to offset the amortization costs of previous player transfers. This helps clubs to balance their books and stay within the financial fair play guidelines. Basically, football clubs consider players to be assets, so do not fully expense transfer fees in the year a player is purchased, but instead write off the cost evenly over the length of the player's contract via player amortization, which is not the same as stage payments. Here is a hypothetical example. If a player was bought on a 5-year contract, then the club decides to sell that player after 1 year. And let's say the player they bought costed £59.7 million, was sold for £44 million, which translates into a net spend of minus £15.7 million. However, we must also account for the player's wages, which is often forgotten about in the media when they report the headlines. The process and how they do it. Rather than showing the cost of £59.7 million in the club's accounts the year they bought the player, the club will amortize the cost of the player who signed a 5-year contract, spreading the player's transfer fee over 5 years, showing £11.94 million per year. Let's say the player's wages was £280,000 per week or £14,560,000 a year. The club add this cost to the player's amortized transfer fee, which works out to the player costing the club £26,500,000 per year. If the player was sold 1 year later, for £44 million, the club can only account for a fifth of the player's transfer fee in relation to the season 2014 to 2015. The £44 million transfer fee accounts for most of this, leaving the club showing a loss of £3.76 million on the deal. After the sale of the player for £44 million, the club are no longer liable for the annual cost of keeping the player. So the £26,500,000 per year it would cost, it is no longer classed as an obligation to the club. When you take into account the total loss made on the transfer, £300,760,000, it can be expressed as an overall profit improvement of £22,700,000 less than they spent the last year. Overall, when it comes to the financial health of a football club, amortization plays an important role in spreading the costs and can also apply to other aspects of running and developing a football club. Annual amortization reduces the value, accounting value and book value, of the player's contract within the end-of-year financial statements. These amortization costs are seen as an annual expense, like the wages paid to players, and thus can be identified in the club's year-end financial statements. Combined with the effectiveness of player transfers and finance costs, all these elements are mission critical to the overall effectiveness of running a football club. We hope this video gave you a better insight into player amortization. If so, please subscribe to the Dynamic Sport Marketing YouTube channel. Thanks for watching.
This was a short introduction from Dynamic Sport Marketing. Please like and subscribe to our YouTube channel for more videos like this.